So good evening, everyone. Welcome to this Markets Thursday, October the 15th. I'm in London. Let me quickly introduce myself through my background. So I started in 2000 in Paris as a cash equity trader, working for a company called Pierre Charon Gestion. Then for another asset manager, which was called DTM, where I was mainly trading European stocks. I started on the French market, went into trading the overall European market, and then a bit of US. And in 2004, I came to London, where I worked from 2004 to 2008 for a hedge fund called Griffin Capital Management, where there were two exposures. One exposure was Eastern Europe, and the other exposure was Western Europe. And I was on the Western European team, where we went from managing 150 million to 600 million on two products, a long-only product and a long-short product. In 2009, I started on a prop trading for Infinity Capital Markets here in London, which is a UK subsidiary of a prop firm called First New York, which is in New York, and where I had an absolute return mandate, no asset and regions constraints. Since 2014, I've been mentoring people from all over the world, working for another company before. And since 2018, I've been working on my own. I've been putting a bit the training on the side and trying to focus more on developing the product. And I launched last year, 12 months ago, the 4x4 video series. And in the meantime, mentoring people, retail traders mainly. So today, what are we going to be covering? So as always, we're going to be starting with the situation across asset classes, looking at stocks, credit, commodities, FX, the Q2 performances, sorry, that was for last week. And we're going to be doing a market review, looking at recent performances and the catalyst. We will be looking at US inflation. Why? Because there has been a lot of talk around US inflation, and the bond market has been moving quite a lot up and down over the last 2 weeks, which was not happening for the last 3 months. We're going to be discussing the earnings season that really started to kick in on Tuesday with JP Morgan and some other banks. Then we'll be covering options trading. So if you've been watching those webinars, you know that options are getting bigger and bigger in the market, and that's something that really we need to understand if we want to become a better portfolio manager. And then we're going to end up with a Q&A session if we have a bit of time. Quickly, I just want to mention 2 reports that were covered this week, and you know that those monthly reports could be useful to us. The first one is the OPEC report, which was on Tuesday, which is giving us a bit of macro understanding. So if you are struggling with the macro picture, actually the OPEC report is a good one. Looking at leading indicators, looking obviously at the oil market overall, but that is a good report. And then we get the IMF report, which is a much, much bigger report. And to be honest, you don't need to go through all of it, but you can find some interesting pieces. So that's something that you could be looking at as well. That helps me for my macro understanding. So hopefully it's going to be the same for you. So asset class performances. So here, this is the year to date. In the year to date, let me take my pen here. Year to date, again, we know which is the big winner, which is the Nasdaq Composite. Europe has been pretty weak. So that's for the stock indexes, sorry, here. Then we jump into FX. You can see that despite all the noise, we are moving between 2 to 5%. So for those of you who are trading FX or who started with FX, you probably start now to understand that there are many more opportunities into the stocks. That doesn't mean that we should not be trading FX. But if you look at the ratio noise versus realized trade, equity is much, much better than FX. On the right-hand side, we get gold that is up 25%, and we know that WTI has been struggling. So that's something that we're going to be looking in the first part of this presentation when we're going to be looking at the price action. On the week to date, the asset performance, the Nasdaq Composite. So that was taken roughly at around 3-4 o'clock this afternoon UK time. So the Nasdaq has been up despite the hiccup that we had since Tuesday. So the Tuesday onwards, we have been a bit correcting on the equity market. Europe has been struggling. China is up 3.5% because the market was closed for a week or so. Currency again pretty flattish on the week, and WTI is down on the week, but it's still around the same trading range, which is getting a bit smaller and smaller, between 39 and 42 roughly. So that is for the asset class performances. In terms of sectors, as always, like almost any week, we get the energy sector that is the worst sector, down 5%. But you can see as well that the financials have been struggling. So we had some good and bad numbers coming from earnings from the different banks. We're going to be discussing that later. But financials have been struggling this week. On the other hand, we get the technology, which has been doing pretty well. So again, that helps me. Hopefully that helps you understanding what is moving in the market. That helps me understanding where I could be going for ID generation as well. Then looking at across other asset classes, the bond. So you remember when we were doing since September all the most of the webinars, this part was not moving on the week to date. And actually, we had a sell-off of US treasuries until last week, where I think the US 10 years went into the 77, 78 bips a week ago, even at the start of this week. There has been a bit of reversion to the mean, but it has been moving. The Bund today, which is the German 10 years, has been moving quite a lot. So last week we discussed the reflation trade. The reflation trade, meaning that like in 2016, there were many hopes that Trump being the new president, and now maybe Biden or Trump, we still don't know, will reflate the system, and that will be obviously putting the yields higher. So that was the idea, and this is why we went into almost 80 bips on the US 10 years. Since last week, there has been a bit of change. Many reflation hope vanishing a bit of the fiscal stimulus happening quickly. And that's something as well that we're going to be covering. But you can see that the German 10 years, Italy has been paying off. So yields are going even more in negative territory. On the VIX is at 28%. Last week we were at 26%, but we are between 25 and 30%, which is pretty high. That doesn't mean it could go higher, but what you have is, if you look at the VIX structure, it's pretty high for the next 6 months. So if you try to compare the VIX structure from 4 years ago, at that particular point in time 4 years ago, the VIX was around 13 to 14%. Meaning what? Meaning that if you do the same trend, long volatility, you are starting with a very different starting point. So that is something to keep in mind, not only for the index, but the overall exposure, if you want to hedge yourself or if you want to take direction. On the top winners, that is always interesting to look at some of the names. We get the NEO, which we're going to be discussing later. And you get some hot names, tech, EV, new technology that are really, really hot. And on the other hand, you have some weaknesses from either structural issues or some for Fastly. So they came yesterday with... So they downgraded the numbers. That is a company that is trading on 50 or 60 times revenues 2020 or 2021, meaning that if you miss or if you lower the expectations by just a bit, the stock is going to be down 20 to 30%. So that's something as well to keep in mind as we are in the middle of the earnings season. Next one, I would like as well to be from time to time, because I'm in Europe, and I know that the people that are following today, some of you are in Europe. Similar to what you do with the S&P and the 11 sectors, you can do the same with the Stock 600 and looking at which sectors have been outperforming or underperforming. That is kind of a similar picture than in the US, but the banks have been really, really struggling. Again, I mean, this is something that we have been discussing for months. I've done many blogs for the last 24 months about the banking sector in Europe. So in absolute terms, this is down 40%. It feels like, with negative yields and the economy deteriorating, there is no end in sight. And on the other end of the spectrum, obviously you get the technology, but you have sectors like chemicals where chemicals is cyclical, are doing fine. So I again strongly advise you, and when we do the mentoring, this is something that I push in the first few sessions, to trying to build your screening of the different sectors. Here we get the sectors, but you can go even further, picking the names and doing ID generation. To me, that is extremely helpful. That is something that I've been doing for 15 years. And literally, when you're working for a hedge fund, or if you're working for a fund, this is something that you'll be doing. So another chart that is obviously coming, and I'm sorry, because we are always all in kind of half lockdown, and this is affecting everyone. But you need as well to be looking at those COVID cases per million. So I don't have the source. This is something that I found on Twitter. But really, you can see that, and we know that Europe cases are just on the rise, and this is something that is affecting the market. Europe has been struggling. You have countries that are changing their levels of emergency. That will be France. That will be the UK. Meaning that going forward, the next 3 to 6 months, the economies where we were hoping for a decent recovery, it's not on the cards anymore. And this is one of the reasons that the equity market has been struggling, that the bonds, the yields have been going lower and lower. But that tells you the picture as well of the market. Let's jump now into the price action, looking at the different asset classes. So here we got the Nasdaq composite. So I was just watching it before we doing the webinar. It's above this trend that we had since 2009. So clearly, technology have been hot, and have been hotter than the, let's say, the average. For the S&P, so far, can I have something that is not just where you can have a look at it properly? So the S&P is still trading into this below this trend. We are not making new highs so far, and that is lagging a bit versus the S&P. Quickly, as we have done, we discussed the equity market in Europe. You can see that Europe is trading sideways. The DAX has been doing quite okayish. It's almost to the all-time high. In terms of currency, euro-dollar, I think this is the chart that it is interesting. There is a lot of noise around euro-dollar. Again, we are at a very important level, I think, one way or another. And here there is a big fight between the dollar bull and dollar bear. And the next few months are going to be very, very important. You're going to have a lot of noise around, obviously, the sterling coming into Brexit and how it's going to react. Turkish lira is still doing what it has to do, which is going lower and lower. In terms of bonds, I think this is the one that we want to be discussing a bit more this week. So this is the US 10 years. I'm going to go from weekly to daily. And as we discussed last week, there has been a spike in yields at the start of the month, and that was across the yield curve. So from very short term to longer term, hopes of reflation, hopes of fiscal stimulus, hopes of probably, Democrats winning everything and reflating the system like there is no tomorrow. On the reflation trade, as I said last week, I'm not 100% with it. On the Democrats winning as well, I don't think necessarily that will be the best case scenario for the market. So you remember we had this hoo-ha phase where the market rallied on the expectation that the Democrats will win everything. If you look backwards, what the market really like is have a good balance between Democrats and Republicans. And here it's not about taking a stance again of if I'm for the Democrats or Republicans. It's really to say that normally you want some kind of balance if you want policy to work well. I think Trump is now catching up. So he was way behind, but everything is to be taken with a pinch of salt. But we could see more uncertainty going into the election one way or another. I don't think this is by far a done deal. And that means as well the market will be looking more in details into what could be the outcome. But the bond market is really where we had the noise. If we look at the German 10 years, if I can put the German 10 years, you can see again that yields are going lower. We are going into lockdown in Europe. European economies are going to be struggling. So it's another leg down. If you look at different sectors, if you look at the IBEX, there are many things that are telling you that winter is coming, and it could be a bit cold. In terms of commodities, CL1, CL2, you decide which one to take, but it's more or less the same picture. We are trading around the 40, 41. OPEC has been talking quite a lot. We know now that we will have to wait at least 6 to 9 months for the supply and more importantly, the demand to go up. And if you look at the future contracts, so if you want to be looking at the future contracts, go on website like investing.com, where you're going to have access. You can see that it's almost flattish. So we are not expecting a big pickup in the oil. Looking at gold, I think which one I like most. I think this one is better. It is still trading in this downside move. Consolidation going up. Again, there is a lot of noise, not really that moving. It's very similar to the euro dollar or the DXY. So it's kind of everything is going to move at one stage. And I think in terms of risk management, be careful in terms of correlation and not putting 5 trades across asset classes, which at the end are exactly the same. So if you long the gold, and if you play euro dollar and you play I don't know what, and you're going to end up with 3-5 positions where you will think those are 3 to 5 different positions, they could be exactly the same. So especially as we are coming into start of November, and it could be moving big time overnight, be extremely cautious on what is your exposure, what is the theme that you'll be playing. Interestingly, the copper has been doing quite hawkish. So what we know is China over the last 3 months, if you look at the PMI, if you look at the hard data, is the part of the world that is doing the best. And there is a lot of oil consumption as well. So Copper is one of them where there is hard demand. And that tells you for ID generation. I discussed some ID generation this morning with one of my mentees who wanted to be long some Chinese ETF versus some European ETF. Clearly, China has been doing well, but there is a but. Like very often, and as we have the elections, we need to monitor what could be the win of Trump, of Biden for China. Obviously, we know what is the first move in terms of price action. But if you look at 2016, actually ETF China did okay the first couple of months. Then when Trump administration really started to say that they will change the deal, then we had a sell-off of Chinese ETF. Let's go back into the slides. Where are we? Here. So the COVID, now the catalyst. Some of the catalysts that I find interesting, which is, as always, looking from one week to another. So for the Eurozone, we have on the 16th some HICP, which stands for the inflation. But more importantly, on the same day, we get retail sales in the US, University of Michigan confidence, and a lot of numbers on the 19th coming from China. So that is something to keep in mind. We have next week many numbers for the housing market. So the housing market has been hot in the US based on lower financing and people moving from cities to out of cities. So next week we get the housing start number, we get the permits, we get as well the NHB number as well. So that's something. And sorry, we got earnings coming from house builders. So that is clearly something that I encourage you to be looking at, because you could have some movers. On the 22nd, again, this is something that is extremely important. We get the presidential debate between Mr. Biden and Mr. Trump. And on the 23rd, the day after, we get the PMI composite flash, which is going to tell us a bit about leading indicator. Why? Because some of the leading indicators are pretty good, and some of the hard data are weakening a bit. So leading, you want to believe that leading, as they are called leading, are more important. But there are some warning that the US economy is slowing, and for sure European economies are really slowing. So to put everything into perspective, if you think about world GDP and you have US that are making roughly 25% of the GDP and Europe that is making 15%, you get 40% of the world GDP that could be struggling a bit. And unless we have new money coming into the system, that might be a struggle. So for the source here, this is a Reuters icon, and this is something that I use every week. Earnings, because we just started the earnings season. Again, I strongly advise you to be looking at the earnings calendar and trying to spot the names that you like and the names as well that you think could be market movers or sector movers. So tomorrow we're going to have a bit of oil services with the SLB. On Monday we get IBM, which already pre-announced, so it's kind of non-event. But what is interesting that they're going to discuss as well their spin-off that they already mentioned last week. For Europe, we get Philips, which is a good proxy of how Europe is doing. On Tuesday, we get some tech names with Netflix, TXI, Texas Instruments, and we get some more, let's say, old school and defensive like Philip Morris as well. So that will be for the XLP. On Wednesday, we get a lot of noise because we get Tesla, we get Chipotle, so many names that have been on fire, and we got as well some defensive like Verizon and IPG to get a better feel of how the ad business is doing, and they might have been struggling in the current conditions. On Thursday, Intel, which is a big name, especially as they missed massively last quarter. So if you've been trading last quarter, you remember that Intel went from 60 to 50, was the overall sector, the SOX, the Philadelphia semiconductor index did pretty well. So that's something that I'm going to be watching. There are some as well, some airlines, there are some metals with Nucor, and you get Pulter, which are going to tell us a bit about how the housing market is doing. And you get airlines as well with AAL and TAL. So that's for the earnings. Again, I find that helpful, knowing every single day who's going to come with the numbers. If you are literally a trader, every day when you come into the office, the first thing that you'll be checking every earnings season is what are the names that are coming on the day. And you not only be checking the earnings, but you're going to be checking when is the company talking to the market. So what about we start with the US inflation? So that's one of the topics that I wanted to discuss. We discussed over the last 2 to 3 sessions as well. So the Fed is mainly looking at one component, which is the PCE. And you can see there is a strong correlation between the core PCE and the Fed fund target. So as long as the inflation is that low, there is no reason for the Fed to raise rates. This is a similar chart than the chart if you do CPI year on year versus the Fed fund rate. So you can see there is a strong correlation. So it's not only because the Fed wants to apply low rates, it's because if there is no inflation, that makes sense to do that. So the question is how the inflation is going to be in the next few years, few months. And actually, on that part, if you want to read the last IMF report, they are explaining quite nicely the competing forces that you're going to have for the US inflation. The first one is you're going to have higher demand for specific products due to lockdown. So that's something we're going to be covering, but we know what happened over the last 6 months. As we have been staying at home, we have been buying products more than usual. Okay, so that has created some specific inflation on certain products. That has created, as well as there was disruption in the supply chain, you might have higher production costs. So again, we're going to be covering that. And the bad effect is that you can really, that is something that is affecting it's the central banks deteriorating credibility. So we know that there is a diminishing returns of QE, of ZIRP, of many things that the central banks have been doing. And as they are saying in this IMF report, credibility can suffer when central banks are regarded as conducting monetary policy to keep government borrowing costs low rather than to ensure price stability. So this is, I mean, even if the IMF is saying that, you know that there is a struggle and really a diminishing return for the central banks. Against that, you have the consumer becoming more cautious on our job or getting sick. So that, I'm going to be discussing that. And as well, the purchasing power transferred to lenders with lower propensity to spend. So what has been happening is, by definition, with a crisis like this, people that are normally spending more, as they have less money, you have, so the top class, let's say, I'm not going to be intensively consuming like the lower class are on some products. And as well, we get the limits of monetary policy ability to stimulate demand. So let me look first at the first point, which is here we get the non-store retailers sales millions of dollars. So this is from the Fred website. And you can see that from here, there has been a massive spike. So what has been happening is we were all sitting at home. We are unable to go to stores, and we were ordering everything through Amazon or to websites. So part of our economies have been benefiting massively. And that means as well that some products have experienced high demand, and high demand meaning very often higher prices. So you have some pockets of inflation in the system. And the question is how the CPI PC is really monitoring this inflation, and if it's going to carry on in the foreseeable future. The second point, which is the same here, that is looking at the impact of those sectors that have been affected most by working from home. You can see the split between the S&P, which is in blue, and in orange, the stay-at-home index, meaning that since March, there has been a massive alpha generation based on buying those 20 to 50 stocks, which were, if you go back here, the ones that benefited from those non-store retailers. Okay, so there is a correlation between those two charts. In terms of supply chain, if there is issue with the supply chain, you could see inflation in the system. So here we get the price of the lumber futures. Probably most of you looked at it when it went from 350 to 900. The question, and I think this is something that I already mentioned, is if next week we're going to be discussing the housing market, but some house builders might discuss what happened over the summer on the lumber prices, because it might affect their margins. So you could have good top line, but actually margins of those home builders where they have been struggling based on this supply chain disruption that we had from June to start of September. Supply chain again, so that is something that is pretty helpful if you want to do a bit of macro and a bit more research. So if you use the University of Michigan Consumer Sentiment Index, they have different tables and different questions. And here, this is the mean probability of losing a job during the next 5 years. And obviously, the longer people are losing their job, or the longer they think that they're not going to be recovering their jobs, the more it's going to be affecting inflation. Why? Because people are not going to be consuming the way they should be consuming. So there is a huge correlation between the two. And even if the NFP, the job market, is a lagging indicator, there is clearly a sign that it is taking longer for the US economy to recover for those jobs. And the longer you stay unemployed, the harder it is going to become for those people to find back this job. Finally, in terms of US inflation, you are not fighting, but you have those strong incentives based on the Fed balance sheet or the ECB on the right-hand side. Why? Because we know that the central banks have been putting a lot of liquidity in the system. We went from roughly 4 trillion to 7 trillion in the US. In Europe, we went from 5 to 7, almost 7 now. So big change. And the question is, as always, if you put that much money into the system, it's going to be inflationary. There is many other points to discuss here, which is the money velocity, how effective central banks will be at targeting inflation, as they have been struggling with inflation over the last 10 years or more. The difference that we have in terms of inflation versus the last 15 years, or even versus 2009, is the fiscal stimulus is much bigger than when it was in 2009. So there is clearly a difference between 2016, 2009, which is if you put that amount of fiscal stimulus into the system, you could end up with inflation. So let's look, for instance, at the US example, where the Democrats wants to do 2 trillion. We had the Republicans who wanted to do 1 trillion top. Now it feels like, you know, at 1.8 to 2 trillion, there might be a deal. Maybe not in the next 4 weeks because this is politics, but afterwards. So if you take 2 trillion, and that is again 10% of the US GDP. If you put 10% of the US GDP through a fiscal stimulus, you might have some inflation somewhere. So there are some very opposite drivers for inflation in the next few months. As we discussed, you could be looking at the 5 years, which I think is a bit of a bullshit. But the CPI this week was fine, so there is no pickup in inflation. But that is, if we want to see another move in the bond market, that has to come from inflation. So let's jump now into the earnings season, where the earnings season, normally the last earnings season was very positive. But I think for this earnings season, we have less visibility coming into this earnings season because less companies have been guiding about what is happening. So here I'm using some data from Refinitiv. So since 1997, the average number of quarterly pre-announcements in the US was 170 companies, whereas in Q2, only 65% pre-announced, and Q3 currently has 73. So you have very few companies that pre-announce. And you can see that the move of the weekly upwards annual earnings revision has been done already. So there has been a big move. So it feels like for this earnings season, expectations are pretty not high, but we are expecting already quite a lot. Again, I think, as always, starting with JP Morgan is a good indicator. So JP Morgan started with good numbers. If you look at the Q3 20 net revenues, which were flattish, but the net income was okayish. As you can see, the big difference between Q2 and Q3 is mainly coming from the provision for credit losses. Okay, so there has been a huge markdown or provision in Q2 for JP Morgan, where they have been very conservative. Whereas for this quarter, with the improvement of the economy, there has not been much provision. So mechanically, your net income is just moving up. But clearly, the JP Morgan numbers were good. Plus, they benefited from a positive investment banking revenue. So if you look at the CIB income revenues, I think market securities services revenue was 7.8 billion. Okay, so that's this one, which was up 29 to 30%. So if you have been a bank like JP Morgan, Morgan Stanley, Goldman Sachs, so Goldman Sachs did very well. Your exposure to investment bank has been helping massively. But on the contrary, if you've been Bank of America, where your exposure to investment banking is much lower and you have really exposure to the US economy, you have been struggling. So you can see that the top line, the total revenue went from 22 billion to 20 billion. And Bank of America has been struggling since then. So this is the net charges for Bank of America. Same story with Q1 and Q2. A lot of provisions and the provisions coming down. Okay. Question is, if you have a second lockdown in the US, I don't think that this is on the card now because the politicians don't want to do it necessarily, and this is all about the numbers of COVID as well. But if you have a second wave of COVID or lockdown, the provision will start to kick in again. And you can see as well some real NPL, or let's say defaults, not only in Europe, but in the US. In terms of alpha generation, so here I use Yahoo Finance. So for those of you who don't have any tools, Yahoo Finance is quite a nice one to be looking at the different name in one sector or in the market. So we get JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, and Citigroup. So as you can see, in green, Goldman Sachs, since the sell-off in March, has been outperforming the market. Why? Because Goldman Sachs is, when you're long Goldman Sachs in conditions like this, you're long volatility. So you're long traders who are trading nicely the market with less exposure to the economy, like stocks for like Bank of America or Wells Fargo. But what you can see on the contrary, that Wells Fargo has been really struggling. I don't think this is only the economy, and this is why when you do the mentoring, when you do your filtering, you look at the quality of the management, you look at the quality of the book. I spent some time this morning with one of my mentees looking at the banking sector in the US and in Europe, and we look at the different criteria, like book value, like price to book, like return on equity. But that is interesting that to see that in the same sector, there is, or industry, there is a lot of alpha generation. The next chart, which is more or less the same, is even more telling, where I picked JP Morgan, Bank of America, and Goldman Sachs. You can see again from March to April, around March, April, Goldman Sachs had been outperforming massively the two. But interestingly, you see the correlation in 2020 between JP Morgan and Bank of America. But, and maybe this is only a but, since we had the earnings on Tuesday for for JP Morgan and yesterday for Bank of America, there has been a widening of the spread. So the question is it going to be earnings momentum? But it feels like JP Morgan could be outperforming Bank of America in the next couple of months. Earnings season, that is interesting as well, to see that as we have a lot of expectations, especially on names that have been pumped up or where there is a lot of concentration and a lot of appetite, if you miss, and then you're going to be destroyed. So here we get the example of Fastly, which is not, as I discussed before, that pre-warned. So they pre-warned on revenues. Again, 70 million plus for revenue per quarter for, I can't remember I think it's something like 15 billion market cap. But more importantly, if you have been playing the names, those names, well done to you on the long end side because you've been making good money. But be careful because I think during this quarter, you're going to be punished. The companies that are going to be missing are going to be punished big time. Similar to this earnings season, I want to discuss the US options. So I know that some of you are always asking me, where to do the ID generation, where to look at US options. So I like the barchart.com website where they have different filtering process. One of them is the unusual stocks option activity. So this one was for Tuesday, but actually that was for the names that were trading on Monday. And first, you're going to have the options single names that are trading more than usual. Okay, so we have the classic name of Apple, which is making many names. Tesla is always on the top. But sometimes you're going to have some names that are going to pop up. If we go into the next slide, that was on Monday. So on Monday, we got a massive spike on the NASDAQ, which was up 2%, and some names just went to the roof. So yes, on one hand, you have clearly a catalyst, which was for Apple, the iPhone coming. For Amazon, you had this Tuesday big day, but more and more those stocks will and are driven by weekly calls. So what I do, what you should be doing, if you get Reuters icon, if you have some other platform, it's about, you know, identifying where these different calls, because most of the time it's going to be weekly calls, are going to be trading. But you can see the spike here where that was for the 125 call, which is expiring tomorrow. We had 300,000 contracts trading. Amazon was more or less the same with 20 to 25,000 call options that were trading on the day. So there is a frenzy of people going for those options. I do have another example. So that's for the number of Apple options contracts. So that's from the FT. And you can see really how the market has been, since March, April, really moving big time from all those options contract. This week we had an interesting move with the NEO. So NEO was upgraded, I think it was yesterday, from JP Morgan. So they were at $15 and I think they went to $40 because why not? And on the left-hand side, I put yesterday's volume on the different strikes. Okay, so we had roughly 782,000 calls traded between 22 and 30 strike. So that gives you, if you do 782,000 times 100, that gives you 80 million shares and nominal. And yesterday, NEO traded 388 million shares. So you can see the spike here. So there is a lot of volume going into some of those weekly calls, and it can be moving to one stock to another. So again, if you could screen this, that's going to be helpful. US option here, the most active stock options, again, go into bar chart or try to find another way of doing this filtering. Finally, the put call ratio. So this is the number of put versus the call. It was pretty low. Similar to this concept, the gamma of the S&P was extremely high. On Monday, I think it was to 10 billion or more. So very aggressive positioning. So as this positioning is very aggressive and we are coming into first tomorrow option expiry, then we're going to have many catalysts. Clearly know that there is extreme positioning through options in the market. Quickly, my education, what I can offer to you is the 4x4 video series, which is a comprehensive online video course where I want to give you a professional investment process. This product was launched in October 2019, where you're going to have a macro analysis and where you're going to be able to build your infrastructure for trade generation across asset classes with a focus on stocks. I want you to be using 4 ways of doing ID generation: top-down, bottom-up, special situation, and active trading, where you're going to get 40 plus videos, which means roughly 30 hours of footage and more than 50 Excel spreadsheets. Second part of my education is the mentoring program, where you can be doing the 4x4 videos series before. I strongly advise you to do it, but there is no obligation. I'm happy to have a Skype call with you to understand what you need and where and if there is synergies. This is 12 weekly one-on-one online sessions. That is similar to the 4x4, but on a more advanced level, where it is about building your infrastructure, looking like we are doing today. What are the catalysts? What is happening? Same thing through 4 processes where we try to consistently generate positive returns by building a balanced portfolio using different asset classes. For those of you who want to have access to the industry, this is a great way to build your track record. Finally, in terms of webinars, I have 3 webinars coming. So next Markets Thursday, actually I decided to change the time to 1 p.m. London time, which will be right before the US Open. Just trying to do a bit different and try to do like a morning meeting if you are in a trading room, and trying to find the drivers on the 22nd of October. This is going to be free. I decided as well to do 2 paid webinars for more advanced people. The first one is going to be on Thursday, October the 29th, which will be around how to trade US elections. If you are looking for trades, if you are looking for good risk reward, I'm going to be helping you generating ideas and looking at good trades across asset classes. And then on November the 14th, that will be 10 trading mistakes to avoid. So I will be sharing some of the mistakes that I've done and some of the mistakes that my mentees have been doing over the years. As well, you can be registering on the mailing list on gregoiredupont.com/seminar if you want to know about what is happening in the future for the webinars. Q&A session, if you have some. If some of you have some questions, the floor is open. I'm all ears. Anyone? If you don't, then we can all go. Anyone's got question? No? Justin, should we reduce exposure for Europe? Look, I think if you look at Europe, if you look at the PMIs, so we looked at it together. Clearly, there is slowdown in Europe. Leading indicators are not looking great. Part of Europe, like Spain, is really looking bad. Italy, as well. France, I'm not gonna pretend otherwise, is not looking good. So reducing exposure, I think it makes sense. The question is when. So this morning I discussed with my mentee who wanted to be long China and short Europe. When you go short or long something through ETF, for example, be careful of what you have, because if you go short the French ETF, for example, a lot of exposure is from French companies that are in the CAC 40, and actually only 10 to 20% of their sales are in France. So most of their exposure is international. So reducing exposure, yes, I think it makes sense. I think there's a second wave of lockdown, of slowdown, and really I can't see a good catalyst. Plus so the second question is from Artak: will Brexit bring new surprises so that we could trade? Look, on the Brexit story, I mean, now we are 4 years into the Brexit. I think hopefully the outcome will come soon. What it feels like, if we don't have a deal just because we get some misunderstanding, or because, and I say that as a French, if your president is fighting for some fishing stories, that is just nonsense. So hopefully we're gonna have a deal. But in this case, you really, I mean, no one knows. Are we gonna delay again after the end of 2020? Look, I don't have I don't know that much, but for Europe, the drivers are not really great. PMIs, hard data are telling you that China, Asia are doing much better. Emerging markets are doing quite well. US are a bit slowing now, but are still doing much better than Europe. And you can see that in a day like today, the move in the Bund was pretty big. So I think the market is trying again to force the hand of the ECB to do something. Does that really make sense for the ECB to go even more negative? I think this is complete nonsense now, and there is diminishing returns for doing more. So I don't think this is a good call for the ECB to do something. Having said that, I'm not a central bankers, and this is not my job. Question for Kevin: do you recommend buying options spreads now to limit volatility falling, or just don't trade options when vol is so high? So we looked at it, you remember, in May, June, July, when we did the mentoring together. As I told you, when the volatility is so high, yes, you need as much as possible sometimes to do spread to limit. Having said that, you don't want all your IG generation or your trades to be the same. And I think it's not only a question of spread. This is always a question of direction. Volatility is pretty high. Okay, that doesn't mean that it could not go higher, but I've been saying it over and over. At the moment, you are paying 25-30% implied vol on the VIX, on the S&P 500, meaning so for many single names, you'll have for the next 3 months very high implied volatility. I just finished a call before with doing another mentoring session. There are some interesting long-dated options, and when I say long-dated, maybe 2021. 2022, sorry, January 2022, if you're looking for longer strategy. I think when you go into something as the US elections, don't go all in on the gross exposure, net exposure, because if the move is not your move, then you have no way to adapt. You're not agile anymore. You don't have the ability you don't have the ammunition anymore. So that is something that I'll be covering when I do this special webinar in 2 weeks, is trying to identify across asset classes which products, which assets you really need to be long and short, or short when you'll be trading that event, because some products will be trading 24/7 and some will not. I give you an example. If you're trading the SPY instead of the S&P future, and last time, which was on the Thursday, all the news came overnight in Europe and in the morning. So that means if you are trading the SPY, you'll have to wait for the US hours to trade to be able to unwind your position or to take a position. If you get the S&P futures, then you can be trading 24/7. So I think if you're not ready and flexible enough coming into this event, you're going to be losing a lot of money. But coming back to your question, Kevin, I think option spread, yes, you can do. You can do some CFDs if you want some leverage with stocks. What else do you want? Question from Santos. Do you recommend trades pivoted on the results of US elections based on the monetary fiscal policies? Yes. I mean, we discussed that last week and the week before. Depending which way you think that who's going to win. There are clearly sectors, industry that are going to be benefiting more than others. We discussed last week renewables, solar, that have been up 30% since there has been this call that Biden will win. Clearly, there is basket of stocks that you could be playing on the election. And if you don't have the stamina to go for single names, you can be going through ETF, which could be less painful. But what could happen is literally on the day of the results is having a big gap, and you need to take into consideration a gap might be coming. This is it. Any question? No. So hopefully I'll see you next week. So the time for this similar webinar will be at 1 p.m. UK time. So I wanted to do that for Australian followers, and that means if you're in the US, you'll have to wake up pretty early. But if you're motivated, anyhow, this is only 90 minutes before the US Open. And as I said, in 2 weeks, I'm pretty excited to do this webinar on the US elections. So I hope to see you either next week or in 2 weeks' time. Talk to you soon. And thank you, all of you, for joining today. Talk to you soon. Bye-bye.